Hello, everybody, and welcome to Outside the Box, the podcast devoted to supporting Central PA's small business. I am your host, Derek Bixler, digital marketer and realtor here in Central PA, born and raised. I grew up on the Hill. Hello to everybody on Instagram over there. I don't want to ignore all those people. I grew up on the Hill, went to Mechanicsburg High School. And then I went to Williamsport to Penn College of Technology, where I studied business and then came back and have been here ever since. Sorry, this Instagram has me all messed up over here. So today we have a guest experts in the house. We have Stonebridge Financial. But before we get to our guest who is going to talk about bubbles, are we in a bubble? How the stock market bubble might affect the economic bubble or the way the market conditions. So before we get into that, I'm going to do a few announcements here. A reminder that we're on Clubhouse now. @Agent Derek is my handle. Please follow me there on Thursdays, 1 to 2 p.m. We are on Clubhouse where you can connect with other small businesses, tell about yourself, network, yada, yada. You can watch last week's episode if you want to learn about what Clubhouse is. A reminder that all the replays are on YouTube, Instagram, LinkedIn, Facebook, soon on iTunes and all the podcast platforms. And we are live on LinkedIn right now. So if you're watching on LinkedIn, I think Susan's out there watching somewhere. If you're watching on LinkedIn or on Instagram or anywhere other than Facebook, please head over to Facebook and go to Support Central PA Small Business and join our Facebook group there. If you have any questions for any of our guests, please put them in the comments. If we don't see them now, we will come back and answer them later. And a reminder to go to supportcentralpa.com to get all of our networking mixer invites. We've got one coming up this Friday at AFH Media, I think. So if you want to get involved with that, sign up for the emails and exclusive offers and all that stuff. And with that, we will get into the episode with Stonebridge Financial. They are in Wormleysburg, and they're going to talk to us about, where's my little bubble? They're going to talk to us about bubbles, economic versus the stock market, and what small businesses should do to assess and react, and to plan for retirement and all that kind of stuff. So before we get into the actual topic, I will introduce each of you. First, Brian McCarver of Stonebridge Financial. Just tell us a little bit about yourself first. Did you grow up in Central PA? How did you get in the business? That kind of stuff.
Hi, Derek. Thank you. Yes, I call myself from Central Pennsylvania, but actually I moved here as the child of a military officer back in the 70s, but I spent 20 years calling this my home. Part of that was spent going to school. I met my wife at Cumberland Valley, and then between college at a military academy and then serving in the Army, I was abroad for about a decade, and then I moved back in the late 90s and started in the industry at that time. And here I am 23 years later doing the same thing. So it's delightful to work and grow a small business in your hometown where you get to spend time with your family and your in-laws, et cetera. So.
And has it always been in Wormleysburg?
It has been at Wormleysburg or adjoining municipalities. For a while, I worked in the Lemoyne area. I think I worked in probably about a 2-mile radius, but I've been in Camp Hill, Lemoyne, and Wormleysburg. So,
do you carry flood insurance in that Wormleysburg building?
Strangely, and I didn't realize this until I bought the property, but we are actually on Front Street in Wormleysburg in the 500-year floodplain, so I'm not required to have flood insurance. So
awesome.
I don't know how we lucked out of finding that spot, but we're glad about it. Beautiful view of the river and no flood insurance.
Exactly. Best of both worlds, for sure. Yeah. As a realtor, I obviously think about that. I pretty much do every search. You don't want to be in a flood zone. Don't want that. Don't want that. But it's hard to, because I pretty much just say you don't want anything in Wormleysburg, kind of, but some stuff isn't in a flood zone. So you have to look a little bit.
That's
nice.
Correct.
And John, where are you from? Where'd you grow up? How'd you get in the business with Brian?
Yes, sir. Well, first of all, thanks for having us on today. I grew up in northern New Jersey, actually, and somehow found my way to central Pennsylvania. Did go to Bucknell University. Never imagined I'd be back to this area.
That's up near me. I pass by Bucknell every time going to Penn Tech. I drove past.
That's right. Yep. But ended up after Bucknell working in Boston for Fidelity and then for Prudential Financial in Manhattan, where I met Brian and our former boss, Luke, and ended up joining them in January of 2002. I always like to say that I was running from a couple falling buildings in Manhattan and didn't stop until I got to Harrisburg. So that's what brought me here. Brian and I ended up working with somebody through Prudential Financial, and Prudential ended up getting merging with Wachovia, and then being gobbled up during the financial crisis by Wells Fargo. And shortly after Wells Fargo took over, we left, started our own independent practice, and that's how we ended up on Front Street in Wormleysburg in 2013.
That's awesome. And you mentioned to me, you used to be above us here in our building. I didn't put that together until you guys told me. Yeah, and there's space available, I said, so you could come back, you could sell your business, come on back and get above us.
That's okay. We're thrilled to be working independently at this point.
Yeah, totally. I hear you. So we'll get right into it. What is a bubble? Let's start with that. What is a bubble? How would you define a bubble? Everybody probably has some kind of idea in their head of what a bubble is. Are we in a bubble? Are we not in a bubble? Let's start with, what would you define a bubble as?
Brian, want to take that?
No, you're up. Go ahead.
All right. So I actually, it's funny. I had to Google what is a bubble before your show, because I wanted to have a good definition of that. And I will say that I think that we don't know if it's a bubble until after the bubble's over. And that's when all the Monday morning quarterbacks come in and start telling us how stupid we all were. So. I don't know if we are in a bubble right now. I will say there's definitely some similarities to previous bubbles. But from in terms of sort of the stages of a bubble, what I would say is we definitely have a few of the stages that would describe how a bubble starts. I mean, the first thing is what would be called displacement, which is some kind of catalyst that happens that is recognized by the early investors, which are also called smart money. All right. So smart money gets in first, and they start looking at things like Tesla, electronic vehicles and battery storage and things like that, or Bitcoin, the concept of the devaluing dollar and alternative currencies. So the smart money gets in there first, and then we have sort of a boom that occurs, and then the institutional investors follow the smart money. And then we get euphoria, where the media begins to hyper focus on, all the great things that are happening with various investments. And euphoria is when the average investor gets in, when the Robin Hood investor begins to get into the markets. And euphoria, I would say, is when your barber tells you about their Bitcoin investments, or your taxi cab driver tells you that you're supposed to be owning Tesla. That's euphoria. I think we're there, if I had to guess. The problem is euphoria could last for a very, very long time before it finally turns into crisis, and then it's described as revulsion when the media becomes broadly negative. If you think back to the mid-90s, Alan Greenspan coined the term irrational exuberance in December of 96. And had people bailed on investments in December of 96, they would have been very, very disappointed over the next 4 years before the asset bubble did finally culminate in March of 2000. We're definitely not calling a top to this market. In fact, I would venture to guess that we're probably not all that close to the top right now. But we definitely have the beginning stages of sort of the typical bubble.
So the beginning stages, meaning we've had the smart money came in first, and then the institutional investors, and now we're seeing all the masses jump in. Yeah. Why do you not think we're at the top yet? And Brian, if you want to jump in on this, obviously you can.
Well,
and we're talking about the stock market, correct?
Well, I think you can talk about bubbles in almost any asset, real estate, bonds, whatever. I can remember probably one of the first recorded bubbles was the tulip bubble way back in, I think it was the 1700s, when people were paying exorbitant prices for flowers, and prices went through the roof. So it doesn't have to be Bitcoin or Tesla. It can be really anything. And history suggests that markets tend to go well beyond what is fair in value in both directions. So whatever fair value is, if we knew it, we'd certainly share it with your crowd. But the point is that fair value can exceed on the upside by a large value, and fair value can, market prices can exceed on the upside of fair value by a large amount, and they can also exceed on the downside by a large amount. I think what John might have been referring to is that there are conditions, economic conditions that probably promote the continuation of these valuations, at least for the near term, and that's where we're a little bit cautious about saying we're at the top or we're somehow going to fall off the valuation cliff, because this can go on for a while. As long as the economy continues to produce reasonable numbers and the government is backing it with stimulus, then you end up having the sort of the surge or the wave or the current behind the economy pushing really market prices higher.
So that's a good question. What bursts a bubble? What causes it to burst? And is that even possible this time?
I would
with
say
the way
that
things are propped up and they're not, I feel like they're not going to let it happen the way it did before. Sorry.
And that's one of the main reasons why what's going on is why this is happening right now. And again, as Brian said, it's not just a stock market bubble. We're talking, stocks, bonds, real estate, Bitcoin. It's assets in general have extraordinarily high valuations. And of course, interest rates are a big part of that. When the Fed is telling you that they're keeping interest rates at 0% until 2023, it's pretty easy to increase your level of risk that you're willing to take with any asset. And it seems very clear to us that the government is uncomfortable with the idea of a recession at this point. I mean, the government seems to be willing to provide more and more stimulus to avoid or get us out of recessions. And it's almost as if the government is implying right now that don't worry, we have your back. You can go ahead and take infinite risk. So, to us, the end of this, again, I hesitate to call it a bubble right now, but the end of this, whatever this is, probably corresponds with the inability of the government to continue down the path that they're taking, whether that's political calls for austerity, or maybe an inflation shock where the Fed says, well, sorry, we can't wait until 2023 anymore. It's now halfway through 2022 and inflation's at 6%. So a lot of things can happen that bring this party to an end. And if you think about it, interest rates and inflation would have a huge impact on every asset class. Interest rates going up make bonds go down in price, but raise yields. If you raise yields, then all of a sudden there's something else to invest in besides stocks. If you raise mortgage rates, then all of a sudden it becomes more expensive to own. So it's definitely a snowball effect that could occur. And it really is, I think, just started by our government's inability to continue down this path.
So is that my next question was going to be, what are the drawbacks or risks for the government propping it up and not letting the market correct itself, so to speak? What risks are there to that, other than it can't keep up? At some point, they can't just keep printing money, or maybe they can. What are the risks of the government propping things up like they have been?
Well, apparently the government can keep printing money because they continue to do so. And frankly, they've done it for well over a decade. So now what I'm personally concerned with is what does the real market look like underneath all of the stimulus? And stimulus can take the format of some sort of subsidy being handed to somebody, which is a check, or it can be in the format of suppressed interest rates that continue to allow people to take risk and then reinvest and whatnot. So, I think what you end up having is you have a lot of phantom companies that really shouldn't be in existence today that are in existence because of the monetary and the fiscal policy of our country.
Yeah.
And that's not healthy. Historically, that's not healthy. Businesses need to succeed and businesses need to fail. And I'd say while the market has broadly helped a lot of people in the conditions under which the government's policies have promoted increased valuations of homes and businesses and stocks and bonds and whatever, it's also created this sort of shadow phantom business world that probably should not be in existence in 2021. And that draws upon the question, like, at what point will the government ever allow a recession to actually happen, or to what extent and how rapidly will those conditions sort of evolve, and how does that price through the markets? Because the markets price things very quickly, as we saw in March. As they often refer to as it's a stair step up and an escalator down in terms of prices.
Yeah,
and
just a couple.
Go ahead.
Well, a couple comments to add to what Brian said. In the last 12 months, companies with negative earnings outperformed the average stock by 40%. That tells you a lot, and that is what was occurring during the latter stages of the tech bubble in the late 90s, early 2000s. Earnings didn't matter anymore, and I don't know if you've heard of the term SPAC yet. Special purpose acquisition company. It's a way to basically create new IPOs via a kind of shell company with a pile of cash that has another company merge into them within a period of time. But the number of SPACs in the first month of this year, month and a half of this year, has exceeded the entire 2019 already. Wow. So we're definitely seeing those signs of excess enthusiasm, but that's what you get when there's 0% interest rates, and there is no alternative. Tina, there is no alternative for investments.
Does Tina know Karen?
Yeah.
Who's Karen? So what about those people that are maybe nearing retirement right now, or they're thinking about they might have to cash out some of their stuff soon? What should they do right now, or in a bubble in general? What should people be doing to prepare for it or react to it?
I think that's an exceptional question, because markets and economies and all that stuff aren't immaterial. They're material, but they're material as we see in the day-to-day lives of people that we talk to. And really what it comes down to is that is how we spend most of our day. We spend most of our day planning out for people who are on the cusp of retirement or at retirement, trying to figure out how to not necessarily avoid bubbles, but to plan around them as much as possible to avoid a situation where you have to sell an asset during a decline like March or December of 2018. So there are a number of people in this country who don't use financial advisors, and that's certainly an option available. But if you're inclined to seek advice and want advice, I'd say at least probably 3 to 5 years before you're thinking of retiring. If your desire to engage somebody in advice, you should probably do so, because it's not that you have to have that much time to prepare, but you have to have that much time to sort of unfold what's available, what resources are available, what your goals are, define them, put them down on a piece of paper, put them down in a plan, and project out under these conditions, I'm going to do this to prevent having to take a responsive reaction during a downturn.
Yeah, it used to be really easy. In 2007, before the markets imploded, we could buy CDs at 5.5% and just ladder CDs for people. Super easy. But there's a temptation, I think, for people to increase their level of risk right now to attempt to add another couple of percentage points of return. The pain of a massive loss is far greater than the joy of an extra 1 or 2% return, especially for somebody who's recently retired.
And so I heard you kind of make the point that diversifying a bit and making sure that you don't have to sell an asset during a downtime is a big part of it. So there's going to be all these ups and downs and bubbles and bursting, but you just want to make sure that you're not in a position where you have to sell that property when the prices are all the way down, or you don't have to sell your stocks to pay for something while the stocks are down. Is that what I'm hearing correctly, is to kind of diversify and cover yourself in different ways so you don't have to cash out at bad times?
Well, simply, yeah. You have to look at life more than 3 days, 3 weeks, 3 months ahead. You have to if you think about what retirement really is, when you retire and you're no longer earning money, you're living off the productivity of other people. So when you don't know what that productivity is going to actually be on the day you retire, you have to plan well in advance that if it's not a very productive economic conditions, that you still have the ability to retire. And that doesn't just end on day one. It doesn't end a year into retirement. It really is for the next 20 or 30 years, just planning it out. And some people plan very well on a spreadsheet. We don't use spreadsheets. We use a little bit more sophisticated software, but you can't sort of just show up and like, hey, I'm retiring today, I hope this works out. It doesn't work out well. I mean, I guess you could if you were worth a lot of money, but at the same time, planning is really the path for most people.
And there's the disbursement and taking the money out, that's a whole plan in itself. Even if you have plenty of money, there are certain ways to take it out and to disperse it, correct? Without to minimize losing it for all different reasons, right?
Yeah, there is, although oftentimes we're looking at that choice from a tax standpoint, because the way you disperse money has an impact on your adjusted gross income, which
that's what I meant mostly, is losing money to taxes. Yeah. Yeah,
exactly. That can impact your Medicare B premiums and things like that. A couple of things that we're advising a lot of clients to do right now. I mean, first and foremost, when you have a Social Security choice, all right, Social Security goes up 32% between your full retirement age, if it's 66, and age 70. So, if you have a choice between owning 0% bonds or 1% bonds and waiting on Social Security, we'd say, wait on Social Security, get an increase there, spend your bonds, spend your low income assets now, so that you can get more Social Security later. Same sort of thing for mortgages. I mean, I guess, it's all about risk tolerance in terms of whether or not you want to pay off your debt. You can always, try to get a 30-year 3% mortgage and outperform it with your assets. But again, a lot of people are holding assets that are not going to be productive over the next 10 years, and they're choosing to maintain their mortgages. And despite those low interest rates, it can still make sense to pay off debt.
Yeah, there's nothing wrong with, even if you can make a better return somewhere else, sometimes it's just nice to pay that off and not have to worry about it, and just some peace of mind and security. So I love that. So in a bubble or a crash, what should you do? Should you so let's say a crash, should you hang in there? Should you sell everything? What should you do when crazy things happen? Obviously, I would think that if you're going to be in it for the long haul, don't go selling everything when it crashes. You just hold tight and stay there, and it's going to kind of all even out over the long haul. But so what should you do? Should you chase those? Oh, this stock is really high in value. We should go buy, what was that one? GameStop. Let's go buy GameStop. I can make a bunch of money on that. And let's go buy this. And, I heard this is down. We got to move our money here. Do you try to coach clients to just, if you have time, we have the money in a good place. We're working on it well, and it's going to be there, and it'll go up and down, but you're in a good place. Don't worry about it too much. So what should we do when we see all these big fluctuations? Should we just hang in there, or should we call our financial planner and say, let's move the money, let's sell? What should I do?
Yeah. I'll take that. I mean, if anybody could accuse us of anything, it's that we're boring. We're not going to provide the type of excitement for people that they will get from trading based on a Reddit forum. So, I don't think we had any clients owning GameStop or AMC or any of those crazy ideas. It was fascinating to watch, by the way, and I did enjoy watching the little guy stick it to the big guy. But then ultimately the little guy is the guy who got hurt on the way back down. So no, I mean, the most important thing is to maintain an allocation that's within your comfort zone. There's always a handful of clients over the last couple decades that end up increasing the risk past their comfort zone when the markets are like this, because they're afraid of missing out. And then inevitably, when the markets go down, they discover that they're not in their comfort zone again, and that forces them to sell at exactly the wrong time. So it really just, you have to maintain an allocation range that makes sense for you and your risk tolerance and your cash flow needs, and you got to stick to it no matter how exciting things are. And as much as bonds, I mean, we recently heard someone call bonds return-free risk, as opposed to risk-free return. Bonds are return-free risk. So there's nothing wrong with holding a lot of cash right now, or just short-term, low-yielding bonds. Inevitably, over the next year, 18 months, 2 years, we're going to get an opportunity to redeploy those assets and make something of them. But for the time being, it's perfectly fine to have a conservative portion of your portfolio that's not all that productive. Yeah.
And I'll add to that. If you look back since the pandemic started in, call it, late February, early March of 2020, there were clear companies. I mean, look, today we're sitting on this platform to do this podcast, and while John and I had the tools to do this on March 1st of last year, so did all of our employees, to basically take all of their work and go home and work from a location that wasn't our main office. So there were clear winners and losers in the economy from, say, March 1st through call it September, October timeframe. The big easy name, Zoom. Who heard of Zoom before March 1st of last year? DocuSign. I mean, some of these companies that just, their utilization just went through the roof because everybody was at home. So if you invested for the entire 2020 based upon what happened from March 1st until October 1st, you would have missed out the fact that starting in about October, November timeframe, there was a fairly serious rotation out of some of those favorable markets or favorable stocks that were sort of at-home stocks into stocks that were sort of left behind. I mean, we're not talking about the cruise lines or entertainment in terms of hospitality, but there were clear, distinct winners in the second part of the year versus the middle part of the year during the stay-at-home. And that's essentially what we try and remind our clients. Like, it's not that we didn't have exposure to what did well in the at-home economy, but the recovery economy had components that frankly did poorly during the stay-at-home economy, and did remarkably well since, especially since the election. But even a month before the election, we saw a fairly significant rotation. So it's not that you can't take on the fringe a little bit of risk and chase a GameStop, although that's a completely separate topic, but chase a Tesla or chase look, this is an exciting idea, I want to invest in it. Go ahead and invest in those things on the periphery and not as a main component of your portfolio, but your main component of the portfolio should be fairly diversified, so that when things zig and zag, you're actually together experiencing positive returns through it all. And that is not a simple thing to do. That's an easy thing to say. That's an easy thing to read in a book. That's an easy thing to talk about in 2000, 2007, 2008, 2009. Those are simple topics. People repeat them all over blogs and say, oh, yeah, it's fine, it's easy. But it's not easy. I mean, we basically have a business because it's not easy. It's hard, and it's emotional. And our job is to be objective and just tell people, like, broadly speaking, if you handle your money this way, it's probably not going to run out by the time you pass.
Yeah.
It's smart to trust a professional, because instead of your buddy that tells you that he just made a whole bunch of money buying some stock, and first of all, it may or may not be true, and there are caveats, and where did he take his money out, and was that a good idea, and all the different things you don't know. All you hear is, he just made a bunch of money on that. Why am I not making a bunch of money on this? Sounds like easy money. So it's not usually as easy as it's cracked up to be, and you got to know what you're doing if you're day trading, so to speak, right?
You hear a lot of success and wins. You never hear the losses. Nobody's admitted to owning GameStop at 485, but somebody bought it at 485. I mean, so, like, I don't know who you are, but you're not happy right now. So, and that's my point. Is I'm not suggesting that there was a lot of money made, but a lot of money made was on the back of somebody losing a lot of money. I mean, if somebody bought GameStop at 15 or 20 or 40 and then sold it at 350 or 400, somebody bought it at 400 or 350, and now it's worth what, $50? I don't even know what it's worth, but that person lost a lot of money. So, wealth is only created if it's created and maintained. Stocks that go up and right back down, somebody made money, somebody lost money. So
eventually fundamentals win. That is always the case. Everything will eventually find its true value, but it doesn't go in a straight line. And believe me, I mean, Brian and I have trained ourselves to avoid sort of the emotional peaks and troughs of investing, because we have to train clients to do the same thing. We still have some serious regrets about not owning 1,000 Bitcoins. That would have been wonderful. But thinking back, just to the S&P 500, which, by the way, is what's called a market cap weighted index. So the biggest companies comprise the majority of the S&P 500. And when things like this happen, the S&P can go through a long period of time of underperformance. I believe that it, from its peak in March of 2000 to I think maybe 2012, it was roughly flat, plus some dividends, but roughly flat for 12 years. That can happen. So, part of what we have to do for all of our clients, including, or especially for retired clients, is avoid the pitfalls of chasing those stocks, remain diversified, even though diversification has been nothing but bad for the last decade. Diversification has not helped anyone for the last decade, but we have to imagine that it's going to help at some point going forward.
Uh-huh.
So this is going out to a lot of small businesses that are watching. How can small businesses specifically react or prepare for, or what should they do during a bubble? Is there anything they should be doing right now to prepare for a possible downturn, or anything specific you would say to a small business owner that might be thinking about investments or just practices in their small business? Any advice you'd have?
Yeah, that's Derek. That's an exceptional question. I was hoping we'd turn it to the small business owner, because I understand that's the majority of your crowd, and we're small business owners as well. So one aspect that I'll try and caution small business owners is that the market and the news and the financial information you receive is not necessarily relatable to where you do business, how you do business, who your consumers are, who your producer, who provides your products, et cetera, et cetera. So you can't go along with the euphoria of what's being televised on CNBC and basically say, oh, okay, the markets are going up, therefore I should take a lot of risk. I should leverage up. I should buy 2 more trucks and 4 more buildings and hire 10 more people. Your interest in taking additional risks should be subject to what you try and understand is your marketplace. So please don't listen to what you hear on the radio or satellite radio or the TV and think, oh, things are peachy, I should just go take more risk and double my inventory, because that's not necessarily the case. I think broadly it gives you context of what's happening globally. But getting as much information from local sources, and especially the marketplace that you work in, is very, very important. One of the benefits of working in South Central Pennsylvania is the stability that the state government provides this region. State jobs and all the associated businesses and professionals that work in relation to the state creates a fairly stable economic base for this area, as well as you add in some military bases, et cetera. Help out. But that doesn't mean this location isn't subject to the ebbs and flows of the economy. We certainly are. But when you hear the unemployment rate is X, that doesn't mean the unemployment rate of your consumers is X. It might be much less than that. Or you might be trying to add employees and you can't find any, and you're saying, well, the unemployment rate's at 7. Like, how can I not find employees? And that's particularly true in the construction industry. The construction industry is, booming right now, and literally people cannot fill the roles that they have for major or for the majority of their construction roles. So that would be my biggest caution to small business owners, is really try and differentiate between the message and the audience that these major publications in the markets are communicating to, and spend a considerable amount of time trying to understand your marketplace. Now, some of that automatically sort of transfers from the national marketplace into local consumers, but there is a distinction.
Yeah. One thing I would say, Derek, interestingly, so we have about, I don't even know how many, 100, 120 corporate retirement plan clients. And remarkably, I don't think any of them went out of business this year. The government stimulus over the past, 12 months is so much larger than anything we've ever seen in our history. And it really was incredibly effective. I mean, I rarely give kudos to the government, but I think I have to in this case. They kept a lot of businesses alive and well, and many businesses were thriving. I mean, obviously the hospitality industry is a different story. And frankly, if I were in that industry, I'd be ramping up right now with anticipation of, a super, super hot second half of 2021. And that's one of the things I would say is, in terms of our expectations for later in the year, we really do think, we had this massive stock market rally. Here we are at all-time highs by far after, a horrible pandemic and a recession. And we might even be in a recession right now because of December's shutdown. But our expectation is an incredibly hot economy during the latter half of the year. I would imagine the hospitality recovers very, very well. There's probably a huge shortage of employees at that point. Probably a lot of wage inflation, frankly. Got to prepare for that. Guessing that we're going to experience a lot of inflation in general, supply chain shortages, and I know that from a builder standpoint, the cost of lumber has gone absolutely through the roof. That's, I think, a theme that we're going to be dealing with a lot in the latter half of this year. But, every business is different, of course, and they all have different impacts. If you had an online business, you've probably been celebrating for the past 12 months. If you had a local mom and pop store, you're not so happy, but that's probably about to change, fairly drastically.
Yeah, I love how you say understand how your industry differs from the others. Just because there's a bubble or a downturn in one area doesn't mean it's everywhere. And maybe there's somebody in your industry that found some thing that you can do, like starting a cloud kitchen and delivering more rather than having dine-ins or whatever the case may be. Look into your industry and don't just go along with whatever's happening in the world at large. There might be something for you to do to. And you also said, don't spend haphazardly. I think Brian said it. Don't just spend all your money when times are good. So times are good. Let's go out and buy all kinds of assets and equipment we don't really need and get more employees and all these things that you don't really need. And then things go down and now you have to deal with all these extra things that you don't necessarily need or can afford anymore.
Yeah. I like the saying that Warren Buffett always says, which is be greedy when others are fearful and be fearful when others are greedy. And right now, a lot of people are greedy. So I'm not suggesting that business owners need to be immediately fearful, but they need to start wondering when that next shoe is going to drop. Actually, years ago, obviously, well before I was born, and this client of mine has since passed away, but her family, her dad was able to have saved a lot of cash prior to the Depression, and ended up buying a substantial amount of farmland in the Cumberland Valley area in the Depression era timeframe, because farmers weren't able to essentially keep their properties. They had to sell their properties. So here he ended up owning hundreds and hundreds of acres in this area because he was positioned properly for the downturn and ended up buying farm. Now, I'm not suggesting we're imminently going to have a depression, but it's just that thoughtfulness of don't get caught up in the wave of euphoria. Really make sure that you're taking risk at the appropriate time, because risk at the inappropriate time will literally put your business under. So.
Yeah. So another question I had is there any way that small businesses can help their employees, coach them or advise them or help them with setting up plans, or anything that business owners can do to help their staff and employees kind of deal with upturns and downturns and the roller coaster of the economy and stock market and things?
I mean, that is our kind of our niche in this area. We do a lot of wealth management. Yeah. Just so happen to have a solution for you. We have a corporate retirement plan team that's led by Jeff Klein, and that is not every employer feels that responsibility toward their employees. We happen to love the employers who sort of are paternal with their employees. They care about them. They want them to retire. Maybe they don't want a bunch of 80-year-olds working for them down the road because they can't retire. So that really is about, not just setting up the right kind of plan and giving them an incentive to save, to invest, but also giving them the right tools and the right education to do so. But one thing that we really found to be incredibly effective on the corporate retirement plan side is to set things up in a way where employees are defaulted to invest. In other words, an automatic enrollment type plan, or a plan that automatically enrolls the employees in the 401k plan and then automatically escalates their contributions over time. Because employees, most of the time, if they don't have to, if they don't have to fill in a form or sign a piece of paper, they're just going to let it go. They're going to do it, and it's good for them. Yeah. So create a plan with as many automatic features as possible to properly allocate investments, get them in the plan, get them increasing their contributions, and provide some kind of match that incentivizes a larger contribution from employees. Super important.
Yeah, I was going to say, people have heard, or generally speaking, the population knows it's almost a necessity for individuals to save for their own retirement, because of the structure of corporate retirement plans now is one based upon you contributing, and then maybe your company will match, et cetera. So people know the right thing to do. It's just getting from what they know to getting it done. The government has actually, and here I go complimenting our government.
Again,
twice in one. Crazy. Never going to happen again.
Yeah, mark this date on the calendar. But they have provided a substantial amount of essentially safe harbors for businesses to do things that have been broadly accepted as the right thing to do, and a business owner can't get sued or litigated based upon picking a default investment or making people enroll in the plan and making them increase their contributions. Now, there's ways around that people can back out and make decisions, but the government has provided business owners the tools to make sure they're going to do the right thing for themselves and save. And that's what it really comes down to. Our job as consultants, and we act as fiduciaries on these plans, is we basically tell business owners, you can do this, 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 and this. And if you do that, 100 out of 100 people won't do it, but 60 will do it on their own. 25 more will do it if we tell them that they have to do it, and 15 they're not going to do it. So you end up increasing contributions or participation in 25% of your population because you've told people that they have to do what they know they have to do. So
probably helps with employee retention too, if you have some kind of retirement plan and way that people can save and automatically they see the benefit in there, and they're kind of tied in this one extra thing they got to deal with if they want to go somewhere else. So I'm sure it helps with employee retention for sure. And I'm sure another great way for people to help their employees is to stay open. So like you said, plan and make sure your business can stay open during a downturn. If you have to send everybody home and you can't pay them for a while, or maybe you can pay for them, but plan and make sure you're in a position where you can stay open during a downturn, and then your employees don't have to look for a new job or be unemployed. Is there anything else you'd add for small businesses to look out for or to do?
I mean, as you said, stay open. I mean, don't over leverage yourself. Don't take on too much leverage. I mean, every time you hit an economic peak, and I guess technically, I mean, this bull market is really only about 10 months old at this point, or 11 months old. But really, it's an extension of the previous bull market as far as I'm concerned. And leverage is extraordinarily high, and eventually interest rates are going to go up. So, use economic activity, use positive economic activity as a way to delever your business, to make sure that you have a rainy day fund. It's shocking the number of companies that would have gone under if not for the PPP loans that were given out. I mean, most companies are not really built to weather a storm for even a couple months. And I guess one of the problems with the PPP loans is I'm not sure anybody learned any lessons, because now we're just going to say, okay, well, if anything happens again, the government's just going to bail us out again. And, eventually the world's going to tell us as the world's reserve currency, sorry, but you can't really do this anymore. You already have 28 trillion in debt and climbing. So, maybe it is time for companies to take some responsibility and to know that they can stay open themselves in the event that something happens.
Yeah, that's well said.
Yeah, I like this comment that somebody put while we were talking about the debt. The debt pay down is zero risk. So
exactly,
you pay that down, there's zero risk in paying that down, and you're going to definitely save whatever that interest rate was. So we're nearing the 50 minutes. So I'm going to ask you guys, we're going to end it with unless you guys have anything else you want to add, we're going to end it with a fun question that has nothing to do with financial planning or money or bubbles or anything. So I'm just Googling fun questions to ask friends. So I have a bunch here. I'll read 3 and then you can choose. We'll do Brian first. Okay, so I'll read 3 of them. What's the worst commercial you've recently seen? What is the craziest thing one of your teachers has done? And when did you screw everything up, but no one ever found out it was you? Those are kind of good.
I'll go with number 2. I was actually with some family last night, and I have 3 wonderful kids. My youngest is a senior in high school and about ready to go to college. And we were out to dinner and we were talking to him and his girlfriend about what life was like when I was in elementary school. And my in-laws were actually affirming this, is that teachers had paddles in their desk drawers and they used them often, and with me as often as anybody else. So, so I can say that I guess the world's a better place because teachers don't have paddles in their drawers, but sometimes I wonder if a couple teachers with paddles in their drawers might be what this country needs to at least revisit once in a while. But we'll see. I don't know if that's the worst thing, but I can remember one teacher in elementary school who was a large man, and he would hit me and make me change my behavior pretty quickly. So anyway, Mr. Weaver, if you're out there, I'm talking about you.
Somebody track him down. Yeah, I probably was at the tail end of them still being allowed to do that, but I remember it. And they even had holes in the paddles so it could pierce through the air real fast. It was, and they
were hung up on the right next to the chalkboard. So like you knew if something went wrong, like you were going to visit Mr. Paddle. So
yeah, I think ours, maybe the principal was maybe the only one, but he would walk around with his paddle around the school and be like, if you get sent down, yeah, I can't believe you were allowed to do that. Crazy. It probably worked though. I'm pretty positive I never did that thing again. Maybe something else, but not that same thing.
Yep.
All right, man. John, you want me to read them again, or you want to do the same?
No,
one?
I mean, nobody watches commercials anymore, so I don't know if I can really answer that one. I didn't even watch the commercials during the Super Bowl. And I'm from New Jersey, so things that teachers did there were horribly inappropriate compared to what teachers may have done around here. But yes, I had a teacher who would throw, the chalkboard eraser at people's heads whenever they interrupted the class. So that was kind of interesting. And I guess with the last question, my problem with answering that is, as Brian knows, I'm an open book. I have no ability whatsoever to hide anything from anybody. So when I screw up, everybody knows it almost instantly afterwards. And I guess my one of my worst screw ups is all the way back to freshman year of high school. On the football team, we had an undefeated season, and it was the last game of the season, and we were tied, and we were on the 5-yard line about to score to win the game. And I went offsides, and we time ran out, and we tied the game.
Oh, that's a good one.
You're that guy.
I still feel bad about that. I still feel bad about that.
Hey, if I played basketball, if you foul somebody and they don't see it or call it, you're not cheating. That's the game. They didn't see it or call it.
Yeah, well, they saw it, and I did it. So.
So before let's tell everybody how they can find you guys. I will put your information up here as we go out, and I'll let you guys read it audibly, because this is going to be on iTunes and the audio only places at some point. So read it out where they can find you, your website, your phone number, and an email if there's an email. If not, you can leave that out.
All right. www.stonebridgefg.com. We are at 602 North Front Street in Wormleysburg. Our office number is 717-736-7007. And you can contact us through our website. There's a general email box on our website.
Yep.
Yeah, if you Google them, and go ahead, Brian.
Well, I was just going to say, Derek, I appreciate this opportunity to speak with you. It's been a wonderful engagement, and we certainly appreciate the connection that you've made with small businesses and the promotion that you're doing therein. So we're grateful for this service to the Central Pennsylvania area.
Yeah,
Thanks.
Thank you very much for having us. I hope you have us on again when the market crashes.
Yeah, I would love that. It's a good buzzword too. It's crashed or something.
Yeah.
Put a big car or something. Well, I appreciate you guys being here too, and you reaching out, and it's a good topic, and we haven't covered it before, so I really appreciate it. And if anybody out there needs any financial services, reach out to Brian. And who's Cody? Cody, I had him on here. If anybody noticed, I had Cody on this episode early this morning. And then Susan emailed me and said, no, he's not supposed to be on it. So I deleted all that. So who's Cody?
He's our practice manager. He's a great guy, but not a student of the markets necessarily. He runs our business.
Yeah.
Okay. So he runs the business. So reach out to John or Brian if you need anything at Stonebridge Financial at stonebridgefh.com, 717-736-7007 in Wormleysburg. And I'll leave the little ticker up there for the rest of the episode as I take us out. A couple announcements. If you're interested in a business spotlight package, which consists of Greg coming to your business, maybe trying out the thing. You saw him at the Ninja Warrior gym trying the warped wall. So he comes, shows behind the scenes of your business live here to everybody. And then you do a interview here, kind of like you're seeing here with Brian and John, a little bit more in-depth interview and talk about you and your business. And then also, if COVID permitting and your business permits, a networking mixer at your location, so we can get some bodies there and hopefully get you some real business out of the thing. So if you're interested in a business spotlight package, I know we are booked out for the mixers until like July, but if you just want to do an episode with me and not all the other stuff, hit me up. I'm always down to do episodes. If you're interested in our special offers, you can join our email list at supportcentralpa.com. We send one email a week, not spammy, just tells you what the networking mixers are coming up, what the episodes coming up are, and the exclusive special offers. And if you want to include an exclusive special offer, that's a tongue tie. If you want to include an exclusive special offer, hit me up and we can include that in there. Again, go to supportcentralpa.com. Join our Facebook group. If you're watching on LinkedIn or IG or any of the other places not on Facebook, please head over to Facebook and join our Central PA Support Small Business Facebook group, and follow me on Clubhouse. We're there every Thursday at 1 p.m. networking with other businesses. If you don't know what Clubhouse is, watch my last episode and I'll tell you all about it. Thanks everybody for listening, and say goodbye, guys.
Yep,
Thank you.
Derek.
Have a good
See
day.
everybody.
Bye.
Thanks.